The Fed is hiking interest rates. Mortgage rates are above 6%. Watch until the end to figure out how to navigate this shifting climate. You're definitely going to want to watch this one. Big news coming out of the Federal Reserve meetings last week. The Fed, they raised the key interest rate 0.75 of a basis point, the highest rate hike in decades. And there's some repercussions. Even before the meeting, we saw the 10-year Treasury bill start to move and mortgage rates spiked above 6%. Huge jump in mortgage rates. That changes a lot of things. And on top of that, after the Fed meeting, the rhetoric and the messaging that came out to the public is, we're going to keep raising rates here. This isn't stopping after this meeting, and that's because the Fed is trying to fight inflation right now. Inflation's reached an all-time high at 8.8%, which is the highest in over 40 years. So this is their chief way to combat inflation. And a lot of people are feeling it right now at the gas pump with goods they're purchasing. The consumer price index is spiking. And what's clear is, based on the definition of a recession, that's 2 consecutive quarters of economic pullback. We saw the stock market pull back 14% prior to the Fed decision, and we've seen inflation go up, which tells us that we are in an economic recession. So knowing all of that, what does it mean for the market? And here's my observations. We know the Fed is going to keep going with these interest rate hikes. So that tells me interest rates on mortgages, they're going to go higher. This isn't the end. We'll have to see how things progress between meetings with the Fed. I wouldn't be surprised if we see rates go north of 7, maybe even 8% by the end of the year. These are possibilities. We just don't know. The Fed has been very clear what they plan to do, and that's going to affect people who plan to transact in the next 6, 12, 18 months. What I also know is that the market has started to decelerate. That's clear. We've talked about it on the show. Here's what people aren't talking about. It feels slow because we were going down the road 250 miles an hour, and when you pull back to 90, that's still really fast. It just feels a lot slower. This is a return to a normal real estate market. We're going to see days on market start to increase. Days on market in the suburbs is less than 3 weeks, or right at 3 weeks in many cases. So we're going to see days on market increase. We're going to see buyers look at more than 1 or 2 or 3 homes before making an offer. These are things that happened pre-2020, pre-pandemic, and we're going to keep going in that direction. What I also know is that if you're thinking about transacting right now, you've got to read the writing on the wall here. And chief economist Danielle Hale from Realtor.com was on CNBC last week talking about this very topic. And what she said is that buyers are going to be surprised as they head into the third quarter of the number of options available with available housing. Pending sales are not outpacing active listings anymore. It's the other way around. We're seeing more new homes come to the market, not more pending sales. So the number of new listings is greater than the number of pending sales dating back since March. We've seen rates go up. That means affordability is going to be lower for buyers. So for those people that want to transact in the next 6, 12, 18 months, if you're a seller, I'd be looking at getting my home on the market now before affordability declines even further. Throw out your schedule, throw out your time frame if you have the ability to do so. And the ability is the key word here. If you have the ability to move to another home and sell your home and cash out, now's the time to do it. If you've got the ability to live with a relative or to go into a short-term rental to cash out high on the sale of your home, now's the time to do it, because as inventory increases, that's the biggest disadvantage for sellers. And a lot of the experts, including Danielle Hale from Realtor.com, she's predicting that. For buyers, if you find a home that's 70% of the way there and you have the ability to lock in your mortgage rate for the next 30 years, I would move on that property. I would have a multiple offer mindset going in and touring these homes, because if you see something you like, you're going to save money just by locking in a lower rate. And if I'm a buyer right now, the biggest thing I'm looking at is, should I be getting an adjustable rate mortgage? Adjustable rate mortgages are going to allow you to lock in a lower rate for 1, 3, 5, 7, or even 10 years than where rates are getting quoted on a 30-year fixed. That is a solution here for short-term affordability. So look at your options. There's a lot we covered here. If you've got something specific, you've got to talk to somebody local, get your situation assessed so that you know exactly what the best way to move ahead is going to be in this changing climate.